First of all, welcome. Thank you for coming. Those of you who have managed to come. On behalf of the Institute, that is SPJIMR, and CFS, which is Center for Financial Studies, my pleasure to welcome Dr. Sam Priyadarshi. Uh, Dr. Sam Priyadarshi is Principal and Head of Portfolio Risk Management at Vanguard. Vanguard's one of the biggest, if not the biggest, so I'm really wrong, fund manager in the US with a huge portfolio. The numbers are there in Google and let's start talk about, but I guess it's like runs into the add equity and debt over trillion.
6.2 trillion.
6 point. I'm so sorry. Saying you will be wrong. By a factor of 6. So it's huge, right? And he looks after the fixed income portfolio, but beyond just the portfolio at Vanguard, he has a lot of experience in both policy formulation and market creation platforms in the US and in some senses the globe, because the US market by far is a significant part, if not, I would say, completely dominant part of the global fixed income market. So we have in him a true specialist in this space, and I, at least personally, looking forward to hearing him share his thoughts about the future of this market. So over to you, Sam. Sam, by the way, he looks Indian. He is Indian. He was born, grew up in Ranchi. He is Bits Ranchi. I am Calcutta. Then PhD at Virginia Tech, and then of course he's spent most of his time in the US now. But we are honored to have you.
Thank you very much, Professor Swaroop, and thanks to the SPJIMR Center for Financial Studies. So I was expecting a crowd bigger than Motera, I'm like this, but this is a more intimate crowd. We can, hang out, chill. Yeah, exactly. I have competition. So, but thank you. I'm truly honored to speak to you today, and thank you all for coming. So let me start with a disclaimer. All the views and opinions expressed today are my own. They are not the views and opinions of my employer. When it comes to it, I'm going to deny I ever said anything. Now, but there is a video recording, so I'll blame it on incoherence from my jet lag and lack of sleep, etc. So I'm going to deny I ever said anything. Now let's move on. So an ancient Chinese curse goes like this: may you live in interesting times. And of all the interesting times, in our lives, these are the most extraordinary, interesting, most challenging, and most cursed times. Many times it seems when watching or following the news, whether it's politics or society or markets or fashion or culture, it seems so surreal and warped and out of sync with what is deemed normal or conventional. So the world seems upside down, and logic, reasoning, and facts don't matter anymore. It seems it's very difficult to make sense of a rapidly evolving world. I've worked in the fixed income markets for 23 years, and I thought I had figured it all out, but obviously I'm wrong. And I know now that what worked in the past won't work anymore in future. So I'm still trying to understand the forces that are affecting the markets and the direction we are headed. So I'm not a futurist. I don't know what the future holds like anyone else. I can't predict. So I want to put it out there that what I'm here to do today is not make any predictions, but to inform you about the current trends and my way of interpolating those trends into the near future. So if you see a dark cloud and relative humidity is high and winds are picking up, you can predict that rain will happen sometime in the future. But if the rain is forecasted, it doesn't happen, you don't kill the forecaster or weather forecaster. And we know they're terrible at forecasting. So let's go through the structure of my talk. So I'll quickly go through where we are today in terms of the fixed income markets. And we will go through the global macro environment and the level of rates and debt. Then we'll talk about the rise of passive investing or index funds. We'll touch on the increasing level of debt and decline in credit quality. And then we'll talk about where we are headed in terms of the fixed income market. So this is kind of like a synopsis of my talk. So I'm going to argue that geopolitical risks will keep rates lower, and a graying world will need a larger safety net, and focus on climate risk related disclosures and filtering will increase, and there will be pervasive use of machine learning and artificial intelligence. So I've vowed not to use the word disruption because I know you're sick and tired of hearing disruption, disrupting forces, this, that, and the other. So in my talk, I'll not use it. So where we are today. So in the aftermath of the global financial crisis, global central banks, the Federal Reserve Bank, the European Central Bank, and the Bank of England, Bank of Japan, they injected massive amounts of liquidity by way of quantitative easing, and by buying trillions of dollars in debt, including in some countries, mortgage-backed securities and corporate bonds. So they also cut rates aggressively and used other unorthodox and unconventional monetary policy tools to revive their respective economies. So in the US, the Federal Reserve Bank cut rates to near zero, and in the European Union, the ECB, they cut deposit rates to negative 50 basis points, or negative 0.5%. So in the years that followed, we had sustained easing and accommodative stance, and terms like low for longer and zero interest rate policy, became popular central bank talk. So today, $13 trillion of global debt are yielding negative rates. So this table shows you the global debt yielding negative rates, and they have negative rates all the way to 10 years in many countries in the developed economies of Europe. And indeed, the Switzerland rate is negative out to 30 years. 30 years, the government is borrowing money at negative 42 basis points. Only in the US and UK you see positive interest rates. And even in the US and UK you see a yield curve inversion, which to many economists and macroeconomists, it foretells a recession, because short-term rates are higher than long-term rates. Means that people are more bullish on the short-term prognosis of the economy than they are about the long-term prospects for their economies. And feel free to interrupt if you have questions. So I argue that the four forces that will shape the global fixed income markets are social political changes that are happening in the world today, demographic trends, innovation and technology, and climate risk. So these are the four forces that we'll talk about and how they will impact the fixed income markets. So the first of these changes are the social political changes that we see across the world in both the developed markets as well as developing economies. So after the global financial crisis, there has been a huge amount of income inequality. In the US, the top 1% of the population, they own 35% of the wealth. And in fact, we are not far from a place in India where the top 1% of the population own 45% of the wealth. So there's a huge amount of income inequality. And globalization in the developed markets has led to an outsourcing of manufacturing jobs and IT services. So, and there were loose immigration policies in the US, UK, and European Union, which led to an increase in immigration and immigrant workers in those countries. So entire cities and many states in the US have become poor, and there's a lot of unemployment in those states. So there's been a severe backlash, and this has given voice to right-wing politics, populism, and nationalism. And indeed, with all that, there's rise of protectionism and decline of multilateralism. So we see populism in UK, US, Italy, And there is anti-immigrant sentiment across the globe. And it's definitely in the developed markets. They don't want to welcome immigrants anymore. And I'm not going to comment about Indian politics in my talk at all. I want to stay out of trouble. So UK has pulled out of the European Union after the Brexit early on January 15th, and is looking to sign bilateral trade agreements with the US and Canada. And the US recently reneged its NAFTA agreement with Mexico and Canada because it deemed that those terms were unfavorable to the US. So they've signed a brand new agreement under the current Trump administration, which is the US-Mexico-Canada agreement. And of course, US comes first, make America great again. So US starts America first policy. So US is in front of all those other countries. And there are, last year we saw massive market movements because of the trade war between US and China. And although phase one of the trade agreement was signed on January 15th, but it was largely a commitment from China to buy agricultural products. So a large swath of the trade between US and China is right now under massive tariffs by the current administration. So a lot is unresolved there. Again, we see a lot of protectionism in the developed markets, and we talked about why this is going on, because there's, again, a huge amount of backlash because of lost jobs and movement of manufacturing jobs. And actually, in conversations last night, people asked if are those jobs coming back to the US? And the answer is no, those jobs will never come back. Because guess where all those jobs are going to? They're not going to China or Vietnam or India. They're going to robots. They're not going to people anymore. Manufacturing is being automated. Those jobs will never come back. So, and also we are seeing the end of American dominance in world politics and world economy. And if you draw a parallel to the mid-19th century when Britain ruled the world and its economy was dominant and its rates were in the double digits because its economy, the British economy was booming. And after the middle part of the 19th century, its economy started declining and its rates fell. A similar thing happened in the 20th century when America became a dominant player after the post-World War II. And the American economy was in a tear and rates went up. But now we're seeing American power diminish and America receding from dominance. It doesn't want to be nation building. It's tired of the wars. It has spent so much time, effort, and money on lost causes across the world, and is no longer interested in being the policing the world or promoting democracy or nation building, and it wants to hand over the keys to China. It's saying, people hate us, here are the keys to world dominance, and good luck with that. So we see end of Pax Americana, and certainly with all that, American economy is not doing well, so rates will continue to drop in the US. And the argument I make today is that higher geopolitical risks will lead to lower rates. So where are the growing income inequality touching on the market? So we see a demand for welfare, healthcare, and retirement benefits in the developed markets because there's so much income inequality, people cannot afford quality healthcare. So in the recent politics in the US, many candidates are offering universal healthcare, which has never happened before in US. It's all paid for. You cannot get free healthcare in US. You have to buy your healthcare. But there is no income to pay for it for people that have been displaced from their jobs. So there is demand for welfare and the demand for healthcare and also retirement benefits. And because of all the era of automation, people need to be retrained. The labor force needs to be retrained. And also students that took on huge amounts of debt to go to American universities, they don't have the level of income or jobs to pay back those loans. So the student loan crisis, debt crisis is massive in the US, and because of all this, governments need to raise more debt to fund the healthcare and retiree benefits. Another issue is that in the US and Germany, there is increased pressure for infrastructure spending, and since the post-depression era, big deal infrastructure built in the US after the Great Depression in the 1930s, there has been little to no money spent on updating or in upgrading the infrastructure in the US. And the roads, bridges, and airports are crumbling. They're not really world class. You go to the richest nation in the world, and the airport is not really anything like what you see in Singapore or even in Mumbai. The airports are world class. So there's a lot of pressure on the government to upgrade their infrastructure, and indeed we can expect massive fiscal stimulus. And today at a conversation we had earlier on, it seems to be a pivot from monetary stimulus to fiscal stimulus, and we see that happening, at least pressure for that to happen in US and Germany and some other countries, I think including in India. There's talk about increasing the amount of fiscal stimulus, right? So all of that will lead to deficit financing and higher level of government debts, which will lead to lower rates. And
why should a high level of debt lead to lower rates?
Because there is more supply, but I'll argue later on that there is demand as well. Okay. And many countries are looking to lower their corporate income tax to spur growth. So what I'm saying here is that there's more, there will be increasing level of government debt financing. Another aspect of the social political changes was after the global financial crisis, there was a concerted effort amongst the G20 countries to reform the markets. And they came out with a lot of regulations which impacted the fixed income markets. So after the crisis, the G20 countries got together in Pittsburgh and they signed a compact which declared that all standardized OTC derivatives have to be traded on exchanges or electronic trading platforms where appropriate and cleared through central clearing counterparties by 2012, and OTC derivatives to be reported to trade repositories. So this is a busy chart, so I'll just give you the highlights of all these regulations. So there was an act passed by the United States Congress called the Dodd-Frank Act, which the central tenet of that was clearing of OTC swaps, real-time reporting, transparency and improved price discovery, and trading on regulated multilateral trade venues, and regulatory oversight to promote market stability, resiliency, and robust markets with impartial access. Another rule is Volcker rule, which prohibited proprietary trading by the banks. The third rule or regulatory reform that came about was Basel III, which imposed higher capital requirements on global systemically important banks. They were required to hold more and higher quality capital, and they were to do stress testing as well as establish a counter-cyclical buffer. So when times are good, they have to hold more capital, because when times are bad, they can release their capital to ensure that they are still liquid. And then finally, MiFID II, which is Markets in Financial Instruments Directive in Europe, it went a step further than even the reforms in US, in that it regulated trading of all instruments on regulated entities. and reporting, near real-time reporting of all transactions, not just derivatives. It also has imposed best execution mandates for asset managers. So massive amount of regulatory reforms following the crisis. The summary of all this is that there is a lot of regulatory pressure to have transparency and improve liquidity and resiliency in the marketplace. And it'll impact the fixed income markets as well. And the next topic I want to touch on in the social, political, and arena is the rise of ESG investing, environmental, social, and governance investing. So this comes in two flavors. One is filtering for unethical or bad companies such as gun manufacturers or casino operators, tobacco or alcohol producers, and so-called polluters. The other way of doing this is by way of scoring your portfolio. So you take your entire holding of stocks and bonds in this case, and you scale them for environmental, social, and governance factors. So you rate each issuer, each QSIP for climate risk, resource efficiency, emissions, human capital management, etc., health and safety, supply chain, remuneration, independence of directors, audit, shareholder right, diversity, how many women are on their board of directors. And then you come up with a score for each bond, and then you weight average your portfolio, and you come up with a weighted average score for your portfolio or fund. And then investors have full transparency into your portfolio. So they kind of are becoming more socially aware in terms of what's happening with your portfolio. So investors have transparency into that. And in Europe, ESG investments have become very popular, and less so in US in terms of retail investors. A small subset of ESG investing is impact investing. So you're not just filtering or scoring, you're only investing in companies that have good ESG practices. So you're only investing in renewable energy, for example. Your portfolio only has renewable energy companies, or your portfolio only has companies that are socially responsible, have good corporate social responsibility, or companies that have good diversity and inclusion. And there's a lot of investors who are demanding impact investing.
So how does impact the returns?
So that is the golden question. And the question is that there is not enough research or data to show whether being ESG conscious is producing better returns. Right? You could argue that with more diversity, like non-ESG companies, your portfolio will be less risky, so you have less concentration. But investors that demand ESG, they're not necessarily looking for outpaced returns. They're exactly. They're yes, and data is mixed in terms of returns on such funds. Yeah, and like in the US, it's not that dominant as it's dominant in Europe.
And the governments also, in that sense, in Europe, they will be promoting this,
Yes,
encouraging this.
yes, they are, and we'll talk about that very shortly. So the next trend I wanted to talk about was demographics. So it's a graying world. Actually, I don't have hair, so I'm not graying. I'm just losing hair. So the world is aging, and demographic trends are going to have a significant impact on GDP. In the developed markets, there's lower fertility rates because of better education. People are marrying late. The economy was bad for a number of years, etc. So the fertility rates are lower compared to developing economies. People are living longer, so there's longer life expectancies. There's better healthcare, which is leading to longer life. expectancies, which means all of this is making the population older, okay? And the percentage of those that are 65 and older will increase from 8% in 2015 to 15% in 2045. And dependency ratios will rise. So dependency ratios are the number of people that are young and old compared to the number of people that are employed, which is roughly 25 to 64. And so the young and old are dependent on those their parents or their children. So that dependency ratio is going to rise, and all of this is going to impact GDP. And how is that going to impact GDP? It's a product of population times participation rate times productivity. So participation rate is the number of people that are employed compared to the population. So participation rate is declining because people are retiring and there is fewer children. So the number of people that are employed is lower. So participation rate is declining. And population is also declining. So because the first two identities in that equation is declining, so population is declining, participation rate is declining. The good news is that productivity is slightly rising because of more efficient economies with technology and so on, efficient use of resources. But the net effect is that aging population will have slightly negative GDP growth. Okay. So as people age, are they going to save more or spend more? So older populations, they will consume less. So older population consumes less. Inflation, it'll be deflationary. And they also have propensity for fixed income assets, at least in the developed markets. There is this whole industry of target date funds where people put money in these funds which automatically adjust. So you pick a target date for your retirement, let's say 2040, and that fund will rebalance every 5 years. So it'll go a certain percentage towards equity, certain percentage towards fixed income. And as it nears the 2040 target date, it'll glide to more towards fixed income. So it's called glide path investing or target date funds, and they're massive in US, and Vanguard manages a lot of target date funds. So there is propensity for an older population to buy more fixed income assets. Now the irony is that lower rates means you have to save more because your earnings are lower because of lower or in fact negative rates. So people have to save a larger percentage of their salary. Indeed, some estimates point to the fact that people may need to save up to 6% more of their salary to plan for retirement.
Any study done on the entire global liquidity? Is it because of easing? Is it going up or down? The total liquidity is going.
Liquidity in the fixed income markets?
The total global liquidity.
Yeah.
So if you are taking a per rate, how does it pan out?
So I'm trying to understand your question. So your question is the
You are telling that most of them are easing, right?
correct, right?
Because of which the liquidity is likely to go up.
So what impact will lower rates will have on the liquidity? The liquidity is a tough question. So it depends on the velocity of transfer of assets, and that generally is declining. And the reason for that is all these pension plans, insurance companies, they are buy and hold investors, and they're not turning their portfolio over, they're just matching their liabilities with the fixed income assets. So liquidity in general is declining.
So when you say velocity is down, it's like it's not fetching good returns.
No, returns like, well, I'm not talking about returns right now. I'm only talking about negative rates or lower rates. And there is easing, central bank easing across the world, globe, developed markets. And the demand from a large swath of the investors is for buy and hold type investors, from like pensions or central banks or even global banks that have to hold capital. So they buy and sit on those bonds. So they're not turning it around. So for that reason, liquidity is going to be lower. And Japan is a classic example of the impact of demographic trends on an economy, and it serves as a cautionary tale for Europe, which is going to look a lot like Japan in a few years. So the economy there has been so bad for so long that they call it lost decade or lost decades now, because it's been bad since 1992. So average rate of inflation in Japan has been 0.3% since 1992. In 2019, its GDP is expected to GDP growth is around 0.8%, with 2020 forecasts calling for 0.6% growth, which is anemic growth. And that's largely because of global trade wars and the China COVID-19 pandemic and VAT issues. It had an unfortunate historic coincidence of a systemic economic crisis and asset price collapse in the late 1980s and early 90s, followed by closely by a structural mid 90s demographic decline and aging population. So not only the population is declining, it's aging very fast, and there is declining labor force. These all these storms have created headwinds, macroeconomic headwinds, for deflationary pressures. And indeed, the fiscal policy has been very erratic, had been very erratic in the 90s, and there was a drawn-out bank cleanup and initially restrained monetary policy by the Bank of Japan aggravated its macro performance in the recent decades. It has had 16 prime ministers in the past 30 years. So it has the economic environment there is not conducive to growth, and the demographic trends, unfortunately, are not supportive of a growing economy. And this is what Europe will look like in the years to follow, or in this decade at least. So you can see how inflation is declining over the past 32 years as the working age population growth is declining.
So there's also a different measurement in economic progress of the country, and which is what is now being talked about is the per capita income and not really look at the GDP growth. Because Japan typically is a classic case.
That's a great point. Yeah, yes, great point.
It's not done that bad because per capita income.
It has held up. Yeah, it has held up.
If you really look at all those measurements,
yes,
you will feel it is done extremely bad.
Agreed.
Compare
the per capita income has held up because GDP is declining, but population is also declining.
Yeah.
Unfortunately, rates track the GDP. The growth in GDP tracks not the per capita income, but other metrics. Okay. Another trend I would like to highlight is that pension and healthcare costs as a percentage of GDP are going to increase, and we talked about the income inequality issues. In developed economies, they have to go up as a percentage of GDP anywhere from 2% to 5%. And for the rest of the world, the current spend on pension and healthcare is 15%, and it's projected to increase to 22%. So the spending on pension and healthcare as a percentage of GDP will rise. It has to escalate to accommodate the growing number of eligible citizens. So I'll give you an example. My dad is 91 today, okay, and he has worked for 30 years. So he retired in 1988, and he has drawn pension for the last 33 years. His pension today is several times higher than his last salary. So I can only hope to live as long as he is living, but I have too many vices compared to him. So now one solution that governments are thinking of is increasing the retirement age. So in India, actually retirement age has gone up, but in US, retirement age has been pushed. The official retirement age where you can start drawing your savings account has crept up over time, and as has the rest of the world. So the retirement age is being pushed since the mid-90s. Certainly in Japan, it's like now you need to be close to 70 in order to retire. In the US, it's not that bad. It's about 62, 65, somewhere between 62 and 65. There's no official retirement age. You can work as long as you want to or are employed, but the ability to withdraw from your savings only kicks in at a particular age, and that is being pushed. Same thing with the rest of the world. So retirement age is being deferred. The other solution, especially in the case of Japan, is to encourage women to join the workforce. And Prime Minister Shinzo Abe, he came up with this brilliant idea. Why don't we have women join the workforce? And it was one of the arrows in his quiver of encouraging women to join the workforce. And there, the participation of women in the labor force is very, very small compared to other developed and developing countries. So the impact of demographics on asset returns will come through from two different channels. So demographic changes will have effects on the aggregate economic growth, as we talked about. It will have an impact on the GDP growth. It will also have an impact on savings and investment preferences. As there is more demand, and Anjan, back to your question, the amount of debt is increasing, but why are rates not rising? And this is the reason why. One of the reasons why is that there's so much demand from a changing demographic or graying world that the risk-free rate is lower, and so is the bond risk premium. So fixed income return is lower. Now there is a feedback loop into equity risk premium because lower rates mean higher equity valuations. So equity returns are higher, but there are counter factual there also, because in the developed markets both equity and fixed income returns are lower than before. So we've talked about social political changes and demographic trends, and now we're going to talk about innovation, and in that we will talk about data science and automation. So this chart here is an extract from a thematic roadmap for the 2030s, and the top trends by impact of happening. So it's a lot of data there. I don't think you should need to particularly read every line there, but suffice it to say that innovation is happening across different industries. So it's not just limited to technology and innovation. It's happening fast. Innovation is not just technology, by the way. It's happening in healthcare. It's happening in energy and environment. By the way, a lot of surgeries nowadays are done by robots, as you know, not just in developed countries, even in developing countries, a lot of surgery is done by robots. Energy and environment, there's a lot of innovation going on. There's innovation in consumer food and retail, industrial manufacturing and transportation, and a lot of these terms are being thrown about. And then, of course, there's changes in society and culture as well. So, for example, entire industries are changing or evolving. To take the example of electric vehicles, which are replacing internal combustion engines. peer-to-peer digital payments, 3D printing. These are just certain examples of how innovation is changing at a faster pace than the past decades. And especially innovation and technology in the financial services industry is a popular term called fintech. And lately we've seen increase in the use of blockchain and use of artificial intelligence for data analytics and predictive analytics. So one major trend in the past decade has been the digitalization of markets, or electronification as they call it in America. So anonymous exchanges with central limit order book, they went from an open outcry where people were shouting buying and sell prices. They've gone completely to computerized matching. This is the trading floor, a picture of the trading floor from 1999. Same spot picture, 16 years later, right? There's hardly anyone. It's all computerized. Okay, so it's gone from physical to a digital exchange, where all the matching is happening on computer servers. There's no physical matching of buyers and sellers. And there is increased use of algorithms, ranging from the simple like VWAP or TWAP algos to liquidity seeking and stealth algos. And there's continuous refinement of algorithms being used in finance, including in fixed income. And this is augmented with transaction cost analysis. So the next generation of algorithms, they use something called an algo wheel, where it's kind of like an algorithm of algorithms. So it's a roulette wheel of sorts, where which algorithm is to be picked is picked by an algorithm. And we use that actually on my team. And we also have smart order routing. So algorithms detect which venue to send the trade to. They look at prices across the different exchanges and venues, trading venues, and then they route the order there. So instead of a human looking at different trading venues, the smart order router itself decides where to send the order to. And then we are also seeing automated order routing. And another trading protocol is the request for quotes, where you send an order for buying and selling to different counterparties, and that's a request for quote. That itself process is being automated and has been automated for a long time now. So auto routing combined with rules-based execution is leading to auto execution, meaning a computer is just doing the order execution itself. No trader is involved. And all of this is with an idea to have straight-through processing. So the order is sent to the trading venue, it is executed, comes back filled. You're cutting hundreds and hundreds of traders and back office people. And fintech is advancing at a fast pace. So the early uses of machine learning and artificial intelligence include data analytics, so looking at a lot of data, and for predictive analytics. It's also being used for underwriting, insurance, and for anti-money laundering, especially at the large banks, because the volume of transaction is so large, and millions of transactions each day. So they're using it for anti-money laundering. Again, blockchain is becoming very popular. So it's a good, clean digital ledger copy of each transaction and how an asset is changing hands. And that we use it today at Vanguard for collateral tagging, transfer, and management of collateral. So we are using it today. It's not just a catchphrase. We also use it for index data management. So we are using blockchain to pass the information between the index provider to the fund manager, so that there's a clean record of the index and the components of the index. And another thing that the finance industry is using and our team is using is natural language processing. So we are extracting data from regulatory filings that companies are required to file with the regulators on the web. So the natural language processing is scraping through those documents and of financial statements. It can actually also read PDFs, and it can transfer all the relevant information into the relevant digestible format. So we use natural language processing. We also use natural language processing for consuming lots of social media data. For example, tagging of financial news. For example, let's say a news story flashes that's a Boeing jet crashed here or there, and it may just be a tweet or some blog post or someone's Facebook feed, but natural language processing can catch it faster, and it will immediately alert the portfolio managers and traders. So it's called sentiment tagging, and it will understand whether it's positive news or negative news. So that has been happening for 4 or 5 years now. And no human cannot read every blog post and Twitter feed. There are millions of them happening every second. It's nearly impossible for a human to keep track of all that. So you just have to identify which issuers, which stock, which bonds you're interested in, and the NLP will do that for you. And it's already extracting data from, like I mentioned, from the web and from PDFs. So where I see financial services firms headed, are they morphing into technology companies? In fact, I'm neither lean nor agile, but I have had to take recently training for lean management and agile training. These are terms used in the IT industry. What does this mean? Basically, agile is like think big, but start very small, minimal viable product, and then fail fast. So you learn by experimentation, and that's what we're transforming into. In fact, my team of portfolio managers and traders globally, we have now or will have in the near future, in the next 4 or 5 months, something called full stack teams. And this is another term from IT industry where there'll be portfolio managers, traders, IT developers, solution architects, UX designers, data scientists sitting together instead of just portfolio managers and traders. And we call them full stack teams. Nearly 5 years ago, there was a term which became very popular called big data, and it was coined as a term to describe immense amount of data. So we went from a few gigabytes a day to petabytes of data in real time, and petabyte is 1,000 terabyte, which is 1,000 gigabytes. So immense amount of data, and not just numbers, but it could be a variety of data. So big data is described by 3 V's. So one is the volume of data, which we just talked about. The second aspect of big data is velocity. So it's a lot of data coming very fast at you. And the third aspect is the variety of data. So it could be video, it could be audio, it could be images, tweets, likes, dislikes on Facebook, reviews, email, news, blogs, what have you. And all of that can be used in the market, financial markets. So it has become nearly impossible to store, retrieve, or analyze using conventional methods. So from on-premise servers, financial services industries, including our firm, has moved to cloud-based computing because it's scalable, much more efficient, and much less expensive. And we use something called data lakes, where all of the immense amount of data is stored there for retrieving and analyzing. So Excel, which was once the standard computing tool in the finance markets and certainly in fixed income, can no longer handle this amount of data. It can no longer handle the volume or the velocity, like real time synchronous data, or it cannot handle obviously video or tweets or blogs and all of that. So the tool of this decade is Python. And actually, a lot of my PMs and traders, including me, had to take Python training. And it's a very easy language to learn. And honestly, I think it's easier to learn than Excel. And it can handle big data very efficiently and in seconds. So it can handle immense amount of data. It can pull directly using web APIs, and it can handle all the data in seconds. Where in an Excel, you open the file and you can go get coffee and it's still opening and reading it. And it's open source, so you can download thousands of different libraries and routines, including machine learning and AI algorithms. So you don't need to be a data scientist. If you have learned Python, you have access to that code, machine learning code and AI code. It's pretty efficient. And like I said, you can use web-based API calls, so you can directly pull data out of the web. In many cases, you have to pay for it. Suppose you're consuming satellite imagery, and I'll talk about that. You have to pay for that data, but Python can read directly from Google. You'll have to still pay Google, but it'll read a lot of the data based on API protocol. And then we have increasing use of alternative data or alt data in financial research. So satellite imagery is kind of like a hackneyed example of alt data, but it's being used. For example, if you look at the parking lot outside a store, Walmart is a big store in the US, and they use satellite imagery to figure out programmatically, not a human being, but programs can read the satellite data and count the number of cars in the parking lot, which means business is good, or business if there are more cars, and if there are less cars, business is not good for Walmart. So they are detecting all that, and humans can't do that really. Same thing with farmlands and crop and the satellite imagery of weather-related data and so on. Freight containers in the oceans, they can detect all that. Also personal data. By the way, everything that you do online, financial companies are mining that data. Your browsing history, your payment record, everything is on for sale. It's anonymized, of course. By law, many countries, including Europe, has very strict rules on use of personal data, but it is being sold and it is being used. Geolocation data, like for example, where you go with your cell phone, that is being tracked. Again, not on an personal basis, anonymized basis, yes. You go to a mall, it's tracking you. Not you by name, but tracking the amount of people in the mall. So GPS tracking, geolocation data is being used for the past 2-3 years. And another thing that is very popular is reading all the online reviews, like on Yelp. I don't know if Yelp is popular here, but when you write reviews, good reviews, bad reviews, finance companies are trying to read all that data and trying to come to a sense of consumer sentiment, whether it's positive, neutral, or negative, about an airline or a restaurant or what have you. And of course, big deal today is the rise of alternative facts or half-truths, and we are using alternative data and combining it with machine learning to parse fact from fiction. And this is a map from a company that specializes in alternative data. I'm not going to go through all of them, but it has several, like 24 verticals of alternative data, like satellite and weather is one, geolocation is another. So immense amount of progress in technology and innovation and the use of it in fixed income markets. The last change I talk about is climate risk, and that is sustainability. So climate change is a slow-moving process, and it's complex, it's non-linear, and it's dynamic, and it's also cumulative. The mechanics of climate change are human activity to CO2 emission, from CO2 emission to atmospheric concentrations, from atmospheric concentrations to global temperatures, and from global temperatures to global climate. And the impact of climate change is broad-based and covering impact to GDP, capital stock, mortality, health, water, famine, displacement, migration, conflicts, biodiversity, and species survival. So today I'm going to only focus on the impact of climate change on GDP. Since climate change is broad and complex, the impact of climate change on GDP is broad and complex. So in this table, studies have shown that a rising global temperature will negatively impact the GDP. And current global GDP is around 100 trillion. By the end of this century, global GDP will be around 500 trillion. And by current climate policy, the temperature by end of this century is projected to be increased by 3.5%. That'll negatively impact GDP by 5%. That means $25 trillion. There'll be an impact to the global GDP, a loss of 25 trillion. That is immense. So I focus on the impact to financial markets, and there will be more stricter carbon pricing regulation, and we touched upon this in environmental, social, and governance investing. Someone had a question about increasing regulatory pressure on understanding climate risk to finance, and the Financial Stability Board, which is a governance council of all the securities regulators worldwide, it has come up with the task force for climate-related financial disclosures. So in Europe, they are going to mandate TCFD reporting or disclosures by companies. And there was a bankruptcy in the US last year of Pacific Gas and Electric, which was the first climate risk bankruptcy. This company declared bankruptcy because of climate risk. Because of the temperature changes, there are a lot of wildfires in California now, and this company went bankrupt. So the first climate-related bankruptcy has happened already. And then now there has been increased issuance of green bonds. So companies are claiming that they're going to use these bonds for sustainable practices, renewable energy, et cetera, et cetera. So we started our discussion with a picture of the current macro climate and accommodative monetary policy, zero or negative interest rates. We talked about the four forces: social, political, demographic trends, innovation, and climate risk, and the current trends. Now we'll assess the impact of all these trends on the future of global fixed income markets. So to summarize, the global macro picture is that we see that developed markets will continue to have low GDP growth. There is low wage growth, but high productivity and low unemployment. So it's a combination of different conflating things. There's declining GDP growth in developing countries. In fact, Chinese 2020 GDP will take a hit from the coronavirus pandemic, and it's supposed to slow down from 6% to 5.4%, and it's the second largest economy. So we can expect aggressive monetary and fiscal stimulus measures from developed and developing economies. So geopolitical risk will keep rates lower, but with increased volatility, there'll be massive fiscal stimulus from governments everywhere. We talked about the decline or demise of multilateralism and increase protectionism and bilateral trade agreements, increase in deficit financing, but we also talked about the demand for safe haven assets such as fixed income, and that will continue to rise in light of the increased geopolitical risks. We talked about the rise of ESG or impact investing, and sustainable investing will become more prominent and mainstream in the years to come. So we talked about a graying world, and it will lead to need for larger retirement, pension, and social safety net plans, higher welfare and healthcare costs. Lower workforce participation will lead to slightly negative effects on GDP growth and increased demand for fixed income assets. We talked about climate risk and the focus on disclosures related to climate risk, ESG scoring and filtering, and we argued that climate change may impact GDP negatively. And then we have to start pricing credit or bonds from a climate risk perspective, and there will be increasing demand for green bonds. So in terms of the technological changes or innovation in the financial services industry, and specifically global fixed income, we've come a long way from stone tablets issued thousands of years ago. From that, we went to bearer bonds, where you had to physically hold certificate, and now we've come to blockchain, and all this is already happening. Everything on this page is already happening. It will become more prominent and mainstream. So technology will reshape global fixed income markets. Debt issuance will become digital, so no more keeping track of this on spreadsheets. So debt syndication, which is currently manual and maintained on spreadsheets, will become electronic. We have companies that are actually facilitating this in the US and Europe, called Dealbook and iPrio. Debt trading will become more automated and algorithmic and highly scalable, and machine learning and artificial intelligence will fundamentally change fixed income and asset management. It will be used increasingly throughout the fixed income ecosystem, from debt origination, debt placement, liquidity provisioning, liquidity sourcing, portfolio construction, order generation, and execution. My team of traders trades over $1.2 trillion globally in fixed income assets. And it's a small team, but we heavily leverage technology right now. So we use automated portfolio construction, optimize our portfolios using algorithms. Orders are generated automatically, orders are placed automatically, orders are executed automatically, and the whole workflow of portfolio management and trading is evolving towards automation. So there'll be fewer needs for PMs like me and traders. So it'll be all done by robots. Not as good looking, but still doing the work more efficiently. So the concept here is that technology will democratize fixed income investing. You don't really need smart people, you need smart algorithms. And it'll make it cheaper and faster and better for investors, and the marketplace will be better for that. And then to tie it all together, for active fixed income, where will the new sources of alpha come from? How will we beat benchmarks? And I present to you these 6 sources of alpha. So there will be smarter and faster use of alternative data. And we talked about the different ways alternative data is being used today. there will be more volatility in rates and FX and credit. So you could profit from smart trading and volatility in these asset classes. You could also do correlation trading across markets, which is actually done on a smaller scale by global macro funds, but it will become more mainstream. I make also the argument that by hedging your tail risk, you will lead to better alpha. By cutting your downside, you are eliminating negative alpha, which is a good thing. And then it'll become more globalized. The trading of bonds, like my team of PMs and traders, they trade globally. So we source local currency bonds in every economy we can tap, which is open to investors, and we also do FX hedging. So that will become more mainstream. So right now only large asset managers do it, but increasing use of global sourcing of bonds will increase. And then active commodity and currency exposures, taking on active bets in commodity and currency exposures. So like I said, the beginning of my speech, I'm not a futurist. I'm not going to predict the future, but I do have one prediction for 2030. And I hope to be happily retired in 2030, smoking cigars and drinking scotch on some beach. So that is the one prediction I'm going to make about 2030, but everything else is pure speculation. So with that, I'm going to open it up for questions. So you all agree with everything I said.
Can you talk about the Indian fixed income market and the financial markets in India, particularly when we see the rates going down on one side and the equities going up, the indexes being in the doldrums? What's happening in the Indian financial market?
I have far better minds sitting here than me to answer that question. I'll direct that question to Professor Swaroop and Vidhu and Hemant. But my take on that is that the trends that we see in global fixed income markets is that low or negative rates, declining GDP growth. You don't see those trends, but you're starting to see that in China, for example, like decline in global GDP, decline in Chinese GDP growth. Unfortunately, I don't have the answer for you for Indian fixed income market because I'm not fully conservant or observer of Indian fixed income markets. I trade globally, but not in India. So I'll leave it to the experts to answer that question.
So is the average world return is also negative, or is it in the positive zone right now?
So 13 out of the fixed income assets globally are 85 trillion, of which 13 trillion is negative yielding. So I would say if you take global GDP growth, it's roughly 3%. So that could translate roughly into world weighted average interest rates globally.
If your team can indicate what will be the GSEC rate in 2030, I think this question is the answer.
Sorry, what?
Indian GSEC.
Indian, yeah. So that even I can make very better retirement plan.
My question is largely about demographics. When you talk about demographics, you said that largely it will lead to rates being lower.
Correct.
And effectively savings in the economies will increase.
Yes.
Because people consume less, as it happened in Japan. Look, what also happens is as people start to, at some point of time, the population will start to decline as well, right?
Yep.
At that point of time, probably the economies or the governments can resort to inheritance tax, or kind of taking away the wealth which belongs to people at a certain point of time, and they can set it off with their deficits which they have at this juncture.
Yeah.
Right.
Mm-hmm.
And effectively, you are actually contracting the amount of money which exists, and not lead to interest rates coming down, but effectively interest rates kind of matching at a better level.
Mm-hmm.
Because if you have interest rates coming down,
Mm-hmm.
I mean it is also reflective of low return on investments, because there's so much of money around and
Right.
lack of investment opportunities,
Right.
which also leads to misallocation. So possibly it may also happen that you can have some of these excesses which exist rather than expanding them, at some point of time there will be a question of contracting. And inflation is one way in which you can also contract.
Right. So inflation targeting is a tool used by.
So effectively, I mean, my point is that if that is the case, then probably interest rates may not remain low for ever. And at that point of time, you may have less money floating around,
right.
and therefore a better level of the savings and investment match each other.
Okay. Now define forever. Are you talking about this decade or?
I'm talking about the foreseeable 10 years, 15 years.
Okay. Yep. All right.
And
Japan has, for 30 years, it hasn't been able to reflate its economy. So, and it used to be the second largest economy. Absolutely. I mean, it has. The conclusion from looking at Japan is
Japan
that
never, destroyed its old capital. The old capital in Japan was never allowed to get destroyed, and which is where return on investment on new capital or the capital which exists is very good. I mean, if that be the case which the world economy chooses, then probably you have too much of capital or probably debt on the liability side, too much of assets on the balance sheet, which have little returns, and therefore both interest rate and ROIs remain.
Which is where the place where Europe is headed, by the way. Same profile.
My question was: is the whole world turning Japan?
Definitely, Europe is. Actually, there was a article done by European think tank, part of ECB, and they said, "Are we all going to be Japanese now?" They were talking about European markets.
So you can target, but you cannot get.
Correct. Yes, you can target all day long, but you cannot get it. I mean, that's what Japan is trying to do. Yes, sir.
Similar to the point which he made, so we have seen globalization leading to almost zero inflation over the last many years or decades. But now with all this trade wars and anti-globalization, do you see a return of inflation?
Good question. So I would say, for a large part, globalization and outsourcing of manufacturing, etc., led to lower costs and lowering inflation. That is kind of still being replaced by technology. So even if economies are becoming insular, like US and UK and so on, they are leveraging technology and automation to keep costs low. Even though globalization isn't what it used to be, technology is kind of supplementing the lack of globalization.
So low inflation is here to.
That's what I'm arguing for.
So you can artificially increase it, right?
Sorry?
You can artificially still increase the inflation if you want to.
No, how can you do that?
By, let's say, minimum support price raising it or something like that. So food inflation might go.
How will you artificially increase inflation?
By giving higher minimum support prices to the farmers. Let's say.
Okay, but that isn't driving global economy, right? I mean, agriculture is very small part of the global economy.
But aggressive deficit financing could lead. So
yeah.
that point
Okay.
So if governments did aggressive deficit financing,
which they are going to do with fiscal
that could
stimulus.
That could be.
It could be inflationary.
Yeah.
Yep. But
not necessarily though, but
Ultimately,
that normal economic theory.
yes. And even Anjan had pointed out, like just growing the stock, the capital stock of debt. Why is that not inflationary? But my point is that there is so much demand. Demand is greater than supply. Exactly.
But if this hypothesis that this low interest rates were to continue for foreseeable future, then if India were to open up its bond market, there will be a rush of money into the country.
Correct. Yeah.
Even after all twists and turns, we have still not reached 6%. So that will be.
Sorry, 6% is what?
GSEC rate.
Okay.
10-year GSEC.
So there is a counter to it. It's not that India is not open.
Slowly
so
opening up.
20 billion.
But it's still not, actually. It's not
20 billion
utilized.
is still unutilized. The thing is, you're talking about the index inclusion. And index inclusion comes, you're talking about the passive funds coming.
Correct, right. So
that's when it will be a tipping point for India. India gets included in index, then we will get.
Yeah, but see, so index inclusion is a long road, by the way. So China recently was included in the global bond index. Index funds didn't just immediately jump into, because China had closed its borders to outside investors. So even if it was included in the global bond index, investors could not access the bonds. So whole ecosystem has to develop, and they had something called Bond Connect, which sorry,
But there is a difference.
From Hong Kong to
so
Shanghai.
Hong Kong to Shanghai.
There's a difference. Unlike China, so bond connect came after they opened up the bond markets for index inclusion.
Correct.
India, bond markets been open for the last 15 years.
Okay.
But we are not having index inclusion. So, for example, if index inclusion happened,
Right.
there's already a lot of foreign investors who are invested in Indian bonds, and there are passive funds which are not investing because of that constraint.
Right.
They will come. I don't think it's going to be taking so much time, like in the case of China, because the infrastructure is already there.
Though there is a crucial thing over here, foreign investors are not investing dollar bonds. They're investing
In China also they are investing CNY.
Local, correct. Local.
The index is
Now,
usually local.
they cannot hedge with CNY because it's restricted. To hedge with
Yeah,
CNY,
there's no
they are doing the Hong Kong
CNH.
CNH.
So
Yes.
there is no restriction in India as such. If you have an underlying, you are allowed to hedge. So
Correct.
to that extent, regulations are
Yeah,
there.
but anyway, Indian rupee is non-deliverable also. So
That's exactly where the index inclusion itself could be a challenge.
exactly.
that.
The moment you have an NDF, non-deliverable forward currency in the index, is a massive challenge for indexers.
But if by chance India does get itself involved,
Yes.
included, I'm saying.
Yeah. So all I'm saying is there
money will start.
there are challenges ahead. Yes, sir.
So you mentioned about longevity,
Yeah.
increasing longevity on one scale. The second concept is that typically when it comes to retirement, you tend to save some money, and then whatever income you generate on those assets, you consume in your retirement years.
Correct.
You don't want to touch your principal.
Correct.
When I see all returns being negative,
Yes.
how does one survive, and where do you invest in retirement?
But buying bonds,
So I'm not sure if you're going to be on the beach in 2030 or still running.
I'll have to buy cheaper cigars and cheaper scotch. Are you telling me that?
Or delay your retirement.
So even my prediction may not come true. Sorry.
It's possible real thing,
But
that's all.
if you're conditioned 40 years with inflation, you
Yeah.
don't accept the fact
So-
that the principal will drop. And
The-
that's where how do you adjust to that?
Yeah, the one thing I would like to point out is that we're talking about sovereign debt. Negative rates are for sovereign debt, although in Europe there are even corporate debt being issued with negative interest rates. By and large, corporate debt is yielding positive yields. And when fixed income investors invest, they invest in a broad swath of fixed income assets, including corporate bonds. If you buy a fixed income fund, generally speaking, typically they will be 70% allocated to corporate bonds, 10 to 20% allocated to these low or negative. So overall, it's slightly more positive. But then your main concern as a retiree is to keep up with inflation. If inflation is zero, what do you get? Right? I mean, if inflation is zero and you're earning zero,
So you still have to make the mental adjustment of eating out of your principal. There's no income that's coming.
agree.
So that's something that
Yeah.
I'm
Especially in the Indian context.
Especially in the Indian context.
Yep.
I think
Okay.
it's more of a behavioral issue.
Yeah.
Financial.
So we have to mentally adjust to zero interest rate policy world.
What is the risk to your theory of this zero or negative interest rates for a longer period of time?
Yeah. When I went to business school, by the way, I still want to find my finance professor. They taught me, and even my PhD, they taught me rates can never go negative. Like I have been trading negative interest rate debt for 5 years. I want to find them and hold them accountable for teaching me wrong facts.
Can you just throw a little more light on tighter tail risk hedging? Is it that we found new instruments, or is it that we've got new insights into tail risk? Or how does one say the tighter tail risk hedging, or the simulations have become better?
There is no such thing as a perfect hedge, by the way. So you have to rethink your hedging strategy. So the way you rethink is, what is the cost of hedging? What is the benefit of hedging? Okay. So every portfolio manager has to come to a determination. What is the tolerance they're willing to live with? So are you willing to take have downside risk for greater upside, or you are only willing to play it safe and conservative, and you want to hedge your downside risk. So there's no answer that fits everyone, not one solution.
Even the hedges has to be, risk of hedges have to be managed, right?
The risk of, yeah, exactly.
Yeah.
Yep. Sorry, I cannot give you an answer because it depends on your portfolio, the currencies, and the markets you're trading in. But what I meant to say is like cutting down your downside risk is a added return to you because you're cutting out the scenarios where you lose.
You know, I just wanted to know how does one make tighter as compared to say 2 or 3 years earlier, as we do it today? Because even at that time we would have imperfections in the hedges that we do, but even today those imperfections will exist. How does that become tighter?
Meaning the tolerance you're willing to live with meaning you make them more tighter, more conservative.
Okay.
So you will not make money when the rates are rallying, but when rates are selling off, you will not lose
So
money.
main thing is that you're building this new source of alpha. All these things are anyway being done by an active trader. It's been always done. For example, active trading of any commodity or currency or tail risk hedging. It's part and parcel of any active trader.
Yes.
Probably it's not new source of alpha. Whereas the first few points, for example, faster and smarter use of alternate data.
Yes.
Probably that's a new source of alpha.
Yeah.
It's
Yeah.
not back.
Agreed.
Cross-market correlation. You mentioned there's much more. Currently, everyone is doing it, but you're saying it'll be much more used by more
Yeah.
traders. And more.
Okay, are there any global forces which could reverse your hypothesis about increasing interest rates? For example, say in India, the fact that there's urbanization and the younger population is growing consumption. If it is just India,
Yeah. Sure.
one could argue that we are not in a declining interest rate.
You know. Yeah.
Standalone.
Right.
We didn't open up the global debt markets and we have our own growth. We probably are still in inflationary 10 years.
Agreed. Totally agreed.
And then when you look at the world as a whole, there is China, there are other emerging economies. So would they not offset some of the inclusions that you find both for Europe and US?
Yes.
And
Yeah. And the answer is yes, but the economy, especially the Indian economy as a percentage of global economy is very small.
Sure.
China, yes. China is increasing. It's a much larger economy compared to where it was, and globally much more significant. And should it continue to grow, which is questionable now in light of all the trade wars and pandemic situation and so on, and protectionism, and demographic changes too. China is aging too, just like Japan. So with all those headwinds, even China, which will someday, if not today, it will slow down. But back to your point, if the economies of developing countries are resurging and on a tear, and rates are rising, and they become bigger and bigger in the context of a smaller global economy, then yes.
So how do you measure the equity risk premium in such a low interest rate environment? I mean, what is the maximum equity risk premium can go to, and what is the end to the expansion in equity risk premiums?
Yeah, a good question, but again, I'm a fixed income person, so I don't know the answer. But I would say, it's very, there are conflating facts here. Like obviously, low rates will lead to higher valuations. Right now, the fundamentals are good for higher equity risk premium, but it's not going to continue to be that good because valuations have started to peak and earnings are declining.
So I had two questions. First, why do you think that equity valuations are so high in the world despite a scenario where it's a debt trap essentially?
Yeah.
Because the demand for debt is being driven by the interest cost itself, which means that the world growth is slowing down. So why are equity valuations are still rising even in the developed market despite that fact?
So
ideally, if inflation is low, your nominal growth is also lower,
Correct,
which
yeah.
means lower earnings growth.
Lower earnings, yes, yeah. So, what's that?
This is not
Then the risk-free rate leads to higher. So it's kind of like cyclical. But to your point, why is valuation so high in equities? Is there is the companies in the developed markets, they have been doing phenomenally well. Like especially technology companies have been they have dominated the global markets, and they have had year after year after year of increasing quarters, and it will come to an end soon. I can't predict when it'll happen, and I'm not a equity portfolio manager. But the earnings will start declining. The growth in earnings will start declining, and the valuations will come down. So equity returns in the developed markets are roughly 4 to 5%, and they will come down too.
And if I may add over there, it's kind of a misleading thing to look at the overall valuation, both in the US as well as in India. Take the top 10 stocks away,
Yeah.
then the valuations are actually not high.
Yes.
Those
Yeah.
10 stocks
Yeah.
have
Yeah. The top 4 stocks in the US are
banks over there, the bank stocks.
FANG
over
stocks
there.
have capitalization of $1 trillion each. So Apple, Facebook, Netflix, Google.
The dichotomy in the valuation on is not so to the extent that the valuation should not be high, they're already the rest of the market is already considering it.
Right.
Valuations are actually fair in line with the growth.
Sure.
It's the few stocks where the money is flowing heavily, that is where it's getting.
True, exactly.
And that's
That's
where
where this passive investment
there
seems
is-
to be
yeah,
feeding into.
and the reason for that money flowing over there, because that is the only place where people are seeing definite growth still happening.
Mhm,
Apple
yeah.
and Microsoft,
Yep.
they still
Right.
believe it will be growing.
Sure.
Like here, HDFC Bank will keep growing.
See, it's good to have a panel of experts helping you answer the tough questions.
How do you pair the portfolio management company on the tech side, AI and adoption? I'm pretty happy with what you guys are doing, but otherwise, more on
So I cannot comment on competition, what competition is doing, but I would say because there's a lot of focus on keeping costs of investment management low, fees low for investors, also increasing demand for generating new sources of alpha. So pretty much every financial services company, every asset manager is trying everything. And a lot of these have become more commonly available. Machine learning, you don't need to be a data scientist. If you have all your data on Amazon Web Service, AWS, Amazon actually has programs called SageMaker, and they're basically a machine learning program. You don't need to know machine learning, you just use that program to do machine learning predictive analytics on your data. So you don't need to be a rocket scientist or a data scientist. Sorry?
Python knowledge.
Python knowledge is extremely easy to acquire. I mean, I highly recommend people. I mean, even I have PMs in their mid 40s on my team, and I tell them to learn Python. It's not really difficult to learn. It's very simple compared to like Visual Basic or something.
Is it true that like GFC, a lot of young CLOs etc. are again making a comeback?
Correct, they are, because there's reach for yield and high yield. And actually, if you look at the ratings, the weighted average credit quality has declined of corporate debt, and there's more high yield, there's more CLO issuance, and so on. Yes, because there is reach for yield.
And who would be the buyers this time?
So there's a lot of I would say it's not in the public markets. So these are close to qualified accredited buyers, and they're largely funds, like private. Think of private equity funds. They are the type of investors in CLOs. So they're not in the public sphere.
They think this time is good.
Every time, exactly. That's true. Yes, sir.
So, how do you view social investing or crowdsourcing of strategies?
Will you put it in the new sources of alpha category or?
It's too nascent right now, I would say. Very nascent. I mean, not enough to make a dent. I mean, we're talking about a market which is 85 trillion. Crowdsourcing is less. It's not even in the billions.
How about the real estate market? How do you see it?
So that is a hard asset. Again, it's outside the realm of fixed income, so I don't trade real estate assets. Right now, there is reaching very high levels of valuation in global real estate markets. Again, I'm not an expert in real estate, so I cannot comment on that. Any other questions?
As a fund house, why don't you invest in India?
I'm sorry, I cannot answer that question. I'm not allowed to speak on behalf of my company. I said I cannot answer. I'm not allowed to answer that question.
You can invest your retirement fund.
I absolutely can. Yes, my own money. Yes. Actually, my own money has to be in Vanguard funds by Vanguard regulations. So I can only do what the Vanguard allows me to do.
Okay.
But unrelated to that, do you see passive investing taking over the passive investment is not exactly passive, is what I imagine. It's still actively monitored.
Correct.
But do you see overtaking the normal fund managers that were the traditional fund managers?
Yeah. So in the equity space, in fixed income, in equity space, passive investing is roughly 40% of the US market. 60% is active. In the fixed income in US markets, it's roughly 25% passive investing. 75% is still active. Okay, like when central banks hold debt, they are not indexed investors, right? And they hold trillions of dollars of fixed income assets. So passive fixed income funds are dominated by BlackRock and Vanguard and a few other players. It's only 25% of the market, but it will increase because the reason for that is become increasingly hard to beat the indexes, fixed income indexes. In fact, an alpha target of 25 basis points to 75 basis points is considered very good. And if you are consistently beating that, you're golden and you're a rock star. But beating that is impossible to do in today's world, given all the things we just talked about. Funds have a total return of roughly 2%, 3%. Because we're talking about negative rates. Especially global portfolios have many currencies that are yielding negative rates. So if your portfolio is returning 2 to 3%, you're good. But beating the index is extremely difficult. For that reason, passive investing will continue to increase in fixed income. And firms like BlackRock, Vanguard are gaining momentum. And the other fact is, and we were talking about this briefly before this talk, the cost of the fees, investment management fees, you cannot really charge high fees when you're earning 1%, 2%. How much can you charge by way of fixed income asset management fees? You cannot charge 1% when your fund is returning 2%. No investor will buy your fund. So you have to continually lower your asset management fees. And in the US, it's commonplace to charge 10 to 15 basis points for index funds. Active funds, you can still command a slight premium, but you have to deliver on those results. Otherwise, people will leave your funds to go to passive funds. So there's two reasons. One is the macroeconomic environment, and it's very hard to beat the indexes.
What is the structure of fee charging of Vanguard?
For fixed income?
No, any investment, anything, any private investment.
There's no private investment. You have to buy public funds. So public funds in the equity, they charge roughly, I would say, for passive funds, 3 to 4 basis points, and for active funds is anywhere around 20 to 25 basis points. For fixed income, it's slightly higher. Like index funds charge 4 to 5 basis points, and active funds charge around 20 basis points. Weighted average Vanguard charges about 11 basis points because lot of the 6.2 trillion we manage is passive. So roughly 5 trillion is passive.
Considerably come down if you compare a decade back.
Oh yeah, absolutely. Yeah. So it's called the Vanguard effect because our competitors are actually closing on us. They have also lowered fees. In fact, one big competitor, Fidelity, they offer some index funds at zero cost.
Yeah, that was the latest a year back.
But even in India, the largest equity ETF is at 6.7 bips.
Oh, that's pretty good. Yeah.
That's the SPJIMR. And that's because it's government money, so it's fund liquid.
So it's a fixed income fund?
No, it's an equity ETF.
Okay.
You cannot compare India and India. The brokers get a lot of other revenues.
Right.
Market is skewed here.
This is the fund 50 million.
That's interesting. 6.7.
So the sovereign debt, the bid offer spreads are very tight. Like in the markets we trade in, they are a fraction of a basis point. The bid offer between bonds, buying and selling, extremely tight market, very liquid markets.
So, Sam, can you think that whether it is fixed income or equity, given the generic view that inflation is here to drive on negative rates, are you allowed to hedge using gold, and with the, especially the view that in such a scenario gold is like
I'm not allowed to use it. No. There are not enough commodity futures as the liquidity in fixed income futures globally. Sure. The gold futures are traded in very small amount.
availability.
Exactly. This.
Always could be tempting.
It would be an imperfect hedge. Well, like I said, there's no perfect hedge, but it would. If you were trying to hedge inflation, you could do Brent crude futures and so on, Brent crude oil futures and so on. I think that is more liquid than gold futures. But you'd have to hedge it with commodity futures, and our funds, fixed income funds, they kind of stick to the knitting by way of being very conservative hedging approach.
So crude price has been found to be to have a more stable relationship compared to gold.
I haven't looked into hedging with crude or gold. So we use duration instruments, futures and interest rate swaps.
You use within fixed income basket model.
Yeah. Yes. Yeah. All the tough questions go to my friend back there, Sanjeev Sinha.
You have heard all the dim talk.
By the way, he's here to call me out on all my bullshit. So I will stop talking. Well, if there are no further questions, it was great. Well, yes, sir.
How much time does it actually take for a fund to recognize a country which has just entered into an index in a fixed income scenario? So, for example,
included in the index?
Yes.
It does take forever. For example, China was included in the global bond index, but index passive funds did not start trading China until recently because of the ecosystem wasn't there, the currency hedging aspect was not there. So if the index was being traded ex-China. So it does take a while to build up the infrastructure, portfolio, and order management systems have to be updated and all that. So it's not immediate. So inclusion in the index doesn't necessarily mean immediate
inflows.
Immediate investments from passive funds. The funds could still trade ex that country.
so long about fixed income. What do you using the word
Rating agencies? I did talk about the fact that credit quality has declined, right? So I would say this, in the aftermath of the GFC, the credit ratings have come under intense scrutiny, and most of the investment firms, they had their own credit analysts and they assigned their own scores. However, by fund offering prospectuses, they have to stick to some prospectus guidelines, investment guidelines. They only use it for that. And basically, they're using their own credit analyst assessment of the credit worthiness of those companies, not using the letter ratings assigned.
Basically, the cost of credit analysis goes up because now you have additional.
You do it in-house.
Yeah, you have to do it in-house. However, technology is helping there. Like now, fewer analysts can cover more companies because of all the data extraction that we're using, the technologies that we talked about. NLP, yeah. NLPs can scan through a lot of the government filings, the 10Q and 10K filings that are uploaded. So they can scrape through it immediately. And actually, the programs scrape it and dump it in Excel. In future, they would not even dump it in Excel. They would just analyze it in Python.
We are looking at conference call transcripts,
audio, yeah, exactly. And actually, there is now technology where it captures the voice trading, which is very infrequent nowadays, by the way. The phone transaction, and it automatically generates the ticket. So it is monitoring the conversation between two entities, say entity A, entity B, and it automatically captures the trade information. Sorry?
Alex.
Yes.
You said that indexing of bonds
Yes.
is a challenge as long as India market prevails.
No. I said that inclusion of countries in the global bond index, but their currencies being NDF poses a challenge.
Yeah.
Because there is slippage between the.
No, I got it. The question is that for India to do that,
Yes.
convertibility is a necessary thing. Because you
I would
can't,
say-
in my opinion, you cannot get away with India as long as rupee is not convertible.
Correct. No, there is like a lot of. Sorry.
Increase convertibility. So to that limit that you would want, you have to.
Outside,
You have-
in some
Right.
jurisdiction, like China's done in Hong Kong.
Through the CNH, right? There's a lot of countries in the global bond index which are non-related. Yeah,
But it's possible.
it is possible. Yeah. Great. Thank you, everyone.
Thank you.
So, before we close, I just wanted to give a quick vote of thanks to Sam and all of you as well. Sam has been at the institute also earlier and was speaking over there with our students for a long year, so it has been a long day for him. Despite that, thanks a lot for the talk. Very structured, very insightful talk. The Q&A, of course, was a delight. Many thanks for this. Very awesome.
Thanks for having me.
Thanks to all of you as well for taking time out on a Monday and coming over here and talking to us. We at CFS would really like to interact much closer with the industry in various aspects and getting guys like Sam over here and research undertakings, etc. as well. We have brochures on your seats and you can take that up. It would be really great. Our contact email is over there. You can reach out to us. And so thanks a lot. Thanks a lot for coming.